All right, so you want to really level up your trading game. Today, we're diving deep into the sneaky psychological traps that can sabotage even the most seasoned traders.
That's right.
You've probably spent hours, who hasn't, studying strategies, indicators, and risk management.
Right.
But what about the mental game?
That's where it gets really interesting, isn't it? You can have the perfect setup, but if your emotions are calling the shots,
Oh, yeah.
it can all unravel pretty quickly. In this deep dive, we're going to dissect those common trading mistakes that stem from our own psychology
Yeah,
and learn how to sidestep them.
I love that. It's like having a cheat sheet for outsmarting our own brains.
Exactly.
So let's jump right in with the first mistake. And this one is a doozy. Entering a trade too late. You know that feeling, right? You see a stock taking off,
Oh, yeah.
and suddenly that fear of missing out, that FOMO, hits you like a freight train.
Oh, FOMO is a powerful beast. It can make even the most disciplined trader abandon their plan and chase a price that's already skyrocketing.
It's tough.
But here's the thing. A late entry usually means buying at the top, just as the momentum is fading. Think about it. How often have you jumped into a trade out of pure FOMO,
Many times.
only to watch it reverse and leave you holding the bag?
Yeah, I've definitely been there. It's like trying to hop on a roller coaster that's already halfway up the first hill.
Exactly. And that's where the pros really differentiate themselves. They understand that missing out on a trade is not a failure.
Right.
It's just part of the game. They have the patience to wait for optimal entry points, even if it means missing out on some initial gains. Remember, there are always more opportunities in the market.
So instead of chasing the price, they're waiting for the price to come to them.
Precisely. They stick to their strategy, they analyze the charts, and they look for those high probability setups that align with their risk tolerance and trading style.
Right.
This isn't about gambling on a quick win. It's about making calculated decisions based on a solid foundation.
Okay, so we've got to tame that FOMO and learn to be patient. But what about when we do find a trade that seems promising? How do we avoid getting carried away and risking too much?
Yeah.
This brings us to our second common mistake, using too much money per trade. It's tempting to think that if a little bit of money makes a nice profit, then a lot of money will make us rich quick, right?
The allure of the get-rich-quick mentality.
Yeah.
It's a seductive trap, but it often leads to disaster in trading. When you risk too much on a single trade, you're essentially letting your emotions take the wheel. Think about it. If you're constantly worried about a big loss,
Yeah.
you're not going to be able to make clear-headed decisions.
It's like putting all your eggs in one basket and then nervously watching that basket like a hawk.
Exactly. You become hyper-focused on the short-term fluctuations of the market, and you lose sight of the bigger picture.
Right.
That's why professional traders emphasize the importance of position sizing and risk management.
Oh, yeah.
They know that it's better to make consistent, smaller gains over time than to chase those risky, oversized wins that can blow up your account.
So it's about finding that sweet spot where you're taking calculated risks, but not putting yourself in a position where a single loss can wipe you out.
Absolutely. Remember, sustainable growth in trading is about managing risk and protecting your capital. Think of it like building a house.
Mm-hmm.
You need a strong foundation to support the rest of the structure.
I love that analogy. Okay, so we've talked about FOMO and oversizing positions.
Right.
But now let's talk about something that can act as a safety net for both of those mistakes. Stop loss orders. This is mistake number 3. Not setting a stop loss. I feel like this is one of those things that every trader knows they should do,
Absolutely.
but it's so easy to skip, especially when you're feeling confident in a trade.
Yeah, it's easy to fall into that trap of thinking, oh, it's just a small dip, it'll bounce back.
Uh-huh.
But the truth is, a small dip can quickly turn into a significant loss, especially if you haven't predefined your exit point.
Mm.
The beauty of a stop-loss order is that it takes the emotion out of the decision-making process. You're essentially saying, if the price falls below this level, I'm out no matter what.
It's like having an insurance policy for your trade.
Exactly. It provides you with a level of psychological safety
Yeah.
that allows you to stay calm and stick to your plan, even when the market is moving against you. And remember, the size of your stop loss can vary depending on your risk tolerance and the specific trade.
Right.
But the key is to have one in place.
So a stop loss is like that friend who gently pulls you away from the buffet table when you've had enough. It's there to protect you from yourself.
I like that. Now let's shift gears a bit and talk about the visual side of trading, specifically our charts.
Okay.
This brings us to mistake number 4, using too many indicators. It's easy to get overwhelmed by the sheer number of indicators available, but piling them on top of each other can actually do more harm than good.
It's like trying to navigate a city with 5 different maps, all with different scales and symbols. You're bound to get lost.
Precisely. Most momentum-based indicators will tell a similar story, so having a dozen of them on your chart just creates noise and makes it difficult to see the underlying price action. Remember, trading is about making decisions based on clear, concise information.
So it's not about finding the magic indicator. It's about understanding a few key indicators really well and using them to confirm your analysis.
Absolutely. Think of it like this. Would you rather have a toolbox with a few high-quality tools that you know how to use effectively?
Right.
Or a toolbox overflowing with random gadgets that you don't even understand?
That's a great point.
Huh.
All right, so we've got to simplify our charts and focus on the essentials.
Yeah.
But what about the bigger picture, the overall direction of the market?
Right.
This leads us to mistake number 5, trading against the trend. It's tempting to try and outsmart the market, to buy when everyone else is selling, thinking you found a bargain. But more often than not, that contrarian approach can lead to some painful losses.
That's because the market has a tendency to move in trends, and fighting against that trend is like swimming upstream.
I see.
Sure, there are times when a stock might be overcold or overbought, but trying to time those reversals perfectly is incredibly difficult.
Right.
Even for the most experienced traders. Remember, the trend is your friend, and aligning yourself with that trend can significantly increase your probability of success.
So instead of trying to predict the exact top or bottom, we should be looking for those opportunities where the momentum is already in our favor.
Exactly. Now, there are various ways to identify the trend, but one of the simplest and most effective tools is the 200-day exponential moving average, or EMA. If the price is above the 200-day EMA, it's generally considered an uptrend. Below the EMA, it's a downtrend. Of course, this is just one indicator, and it's important to confirm your analysis with other tools and strategies.
Right.
But it can provide a good starting point for understanding the overall direction of the market.
So we're essentially looking for those stocks that are riding the wave, so to speak, rather than trying to paddle against the current.
That's a great analogy. Now let's dive into our final mistake, and this one is often overlooked, but it can be incredibly valuable for improving your trading: lack of record keeping.
We're talking about keeping a trading log, right? I feel like this is one of those things that every trader knows they should do.
Absolutely.
But it's so easy to put off, especially when you're in the thick of things.
I completely understand, but trust me, a trading log is an invaluable tool for both profit and self-improvement. It allows you to step back and analyze your trades objectively, identifying patterns and trends that you might not have noticed in the heat of the moment.
Welcome back. We've been unpacking some of the most common trading mistakes, and it's clear that our own minds can be our biggest obstacles. But let's dig a little deeper into this idea of a trading log. It sounds simple enough, but how does it actually help us become better traders?
It's all about bringing awareness to your actions and your thought process. Imagine this. You've just finished a trading session. Instead of just closing your laptop and moving on, you open up your trading log and force yourself to relive each decision. What were you feeling? Were you following your plan, or did you get swept up in the moment?
So it's like hitting the replay button on our trading day and really dissecting those key moments.
Exactly. And over time, as you accumulate more data in your trading log, you start to notice patterns. Maybe you see that you tend to make impulsive trades after a big win, or perhaps you notice that you hesitate to take profits because you're afraid of missing out on further gains.
It's almost like we're creating a psychological profile of ourselves as traders, identifying those blind spots that we might not even be aware of.
That's a great way to put it. And once you've identified those patterns, you can start to develop strategies to overcome them. For example, if you notice that you're prone to overtrading after a winning streak, you might implement a rule that you'll only take a certain number of trades per day or per week. Or if you find yourself holding on to losing positions for too long, you might set a hard stop-loss rule that you'll exit a trade automatically if it hits a certain percentage loss.
So the trading log isn't just about recording data, it's about using that data to develop a personalized game plan for success. But even with the best laid plans, we're still going to encounter losses in trading. How do we deal with those losses emotionally without letting them derail our confidence?
Losses are inevitable in trading. The key is to view them not as failures, but as opportunities for learning and growth. Remember, even the most successful traders in the world experience losses. What separates the pros from the amateurs is their ability to bounce back from those losses and continue to refine their approach.
But it's easier said than done, right? It's hard not to take those losses personally, especially when you've put a lot of time and effort into a trade.
That's where the trading log comes in again. By reviewing your past trades, you can start to detach yourself from the emotional aspect of losing and focus on the technical reasons why the trade didn't work out. Did you misinterpret a signal? Did you enter the trade too late? Was your stop loss too tight? By analyzing those details objectively, you can extract valuable lessons from each loss and avoid repeating those same mistakes in the future.
So it's about turning those losses into data points, into learning experiences that ultimately make us better traders.
Exactly. And remember, trading is a marathon, not a sprint. It's about developing a sustainable approach that's built on discipline, risk management, and continuous improvement.
Okay, so we've got to be patient, we've got to manage our risk, and we've got to learn from our mistakes. But let's be honest, trading can be a lonely and isolating endeavor. We're often staring at screens for hours on end, making decisions in a vacuum. How do we stay motivated and avoid burnout, especially during those inevitable periods of drawdown?
You're right, trading can definitely feel isolating at times. It's important to remember that you're not alone in this journey. There are countless other traders out there who are going through the same ups and downs. Connecting with those traders, whether it's through online communities, forums, or even local meetups, can provide a sense of camaraderie and support.
It's like having a team of people who understand the unique challenges and rewards of trading.
Exactly. Sharing experiences, strategies, and even just venting frustrations with like-minded individuals can make a huge difference in your overall well-being and help you stay motivated during those challenging times.
It's like having a support group, but for traders. Okay, so we've got community, but what about our own internal dialogue? How do we cultivate a mindset that's conducive to success in trading?
One of the most important things is to develop a growth mindset. This means embracing challenges as opportunities for learning rather than seeing them as setbacks. Remember, trading is a skill that takes time and effort to develop. There will be bumps along the road, but it's important to view those bumps as stepping stones to improvement rather than roadblocks to success.
So it's about focusing on the process, on the journey of continuous improvement, rather than getting hung up on individual wins and losses.
Absolutely. Yeah. Another important aspect of a successful trading mindset is to focus on what you can control. You can't control the market's every move, but you can control your risk, your emotions, and your decision-making process.
So it's about taking ownership of our actions and not letting external factors dictate our emotions or our trading decisions.
Precisely. And finally, don't be afraid to celebrate your wins, no matter how small they may seem. Trading can be a tough game, so it's important to acknowledge your progress and give yourself credit for the hard work you're putting in.
It's like giving yourself a pat on the back for a job well done. Okay, so we've got to focus on growth, control what we can control, and celebrate our wins. Any other mindset tips that can help us stay on track?
One that often gets overlooked is managing expectations. It's easy to get caught up in the hype of trading and think that you're going to become a millionaire overnight. But the reality is that trading is a skill that takes time and effort to develop.
So it's about being realistic about the learning curve and not getting discouraged if we don't see immediate results.
Exactly. Set realistic goals, focus on the process, and celebrate those small victories along the way. Remember, trading is a marathon, not a sprint. It's about developing a sustainable approach that will allow you to thrive in the markets over the long term.
All right, so we've covered a lot of ground today, from the technical aspects of trading to the emotional and psychological side of the game. I feel like I've gained a whole new perspective on what it takes to be a successful trader.
It's been my pleasure sharing these insights with you. Remember, trading is a journey of continuous learning and growth. Embrace the challenges, seek out knowledge, and never stop striving to improve.
Well said. We'll be back in just a moment to wrap up our deep dive into the world of trading and leave you with some final thoughts to ponder as you continue on your trading journey. Stay tuned. Welcome back to the deep dive. Today, we've been on quite a journey, haven't we? We've explored those common trading mistakes, the power of a trading log, and the importance of cultivating a growth mindset. But it seems like there's a deeper theme running through all of this.
I think you're right. What we're really talking about is self-awareness.
Yeah.
Trading has this incredible ability to expose our strengths and weaknesses, both in terms of our technical skills and our emotional resilience.
It's like trading is holding up a mirror reflecting not just our financial habits, but also how we approach challenges, make decisions under pressure, and learn from our mistakes.
And what's fascinating is that this self-reflection can have benefits that extend far beyond the markets. The discipline, emotional control, and analytical thinking you develop as a trader can positively impact other areas of your life.
That's where it gets really interesting. Imagine applying those skills to things like negotiating a raise, sticking to a fitness plan, or even just making more rational choices in everyday life.
Exactly. The principles we've discussed today, patience, discipline, risk management, self-awareness, these are all transferable skills that can empower you to achieve your goals in any field.
So trading isn't just about making money, it's about personal growth and self-discovery. It's about becoming a better version of ourselves.
I couldn't agree more. And that's why it's so important to approach trading with the right mindset. It's not about getting rich quick. It's about embracing the journey of continuous learning, adapting to challenges, and constantly striving to improve.
So if we had to distill all of today's insights into one key takeaway, what would it be?
Never stop learning.
Okay.
The markets are constantly evolving, and so should you. Read books, attend webinars, connect with other traders, backtest your strategies, experiment with different approaches, and most importantly, never be afraid to challenge your own assumptions.
Beautifully said. And on that note, I want to leave our listeners with a final thought to ponder. What if, instead of just trying to avoid mistakes, we challenged ourselves to actively seek out the best possible decisions in every trade? What if we focused on making every entry, every exit, every risk management decision a reflection of our best selves, our most informed and disciplined selves?
That's a powerful shift in perspective.
Yeah.
It's about moving beyond simply avoiding losses and striving for excellence in every action we take. It's about recognizing that trading, at its core, is a reflection of who we are and who we aspire to become.
So it's not just about becoming better traders, it's about becoming better versions of ourselves, and that's a journey that can truly transform our lives, both financially and personally.
I think that's a perfect note to end on. Remember, the markets will always present challenges, but it's how we respond to those challenges that ultimately determines our success.
This has been an incredible deep dive into the world of trading. Thank you for joining us today, and we'll see you next time on The Deep Dive.